What's up, guys? Welcome back to This Just In. Thank you for joining me today. In this video, we're going to take a look at the Opendoor stock. That ticker symbol is OPEN. We might have some huge opportunity here because the price has recently pulled back to a major support level. So I wanted to jump on, break it down for you, and give you my thoughts on where the price could be going from here. So let's jump right in. All right, guys, before we get started today, subscribe to the channel for me. Remember to hit the little bell. That way you get a notification every time I post a new video. There's also going to be a link down in the top pinned comment to my Patreon account. Come over and join the family. We've got an awesome community over there. That'll get you access to the private Discord where we talk stocks. You'll be able to check out my portfolio with all of my high conviction fundamental analysis plays. I also send out all of my swing trade setups, like anytime I take a trade, my stop loss, entry, profit targets, just so you know exactly what I'm doing on that trade. And then I send out my watch lists, like anytime I break down a chart and the technicals look really good, I put that in front of you so you know what I'm looking out for. We've also got education over there that you can use to become a better investor. So if that's something you're interested in, definitely take advantage of it. The Patreon is the #1 way to support the channel, and I would really appreciate it. We're all independent over here, guys. We don't do any sponsors. We will never take on sponsors, never shill you any, garbage penny stocks or anything like that. The only thing I do is run ads on the YouTube videos. So Day One Squad, I love you. Thank you so much for your support. There's also my Instagram and Twitter down in the description below as well. Go follow me over there if you want to see me post on a more frequent basis. I'll also include my personal Instagram over there, so if you want to see me acting the fool and being a hooligan, definitely, go follow that as well. Guys, let's get started. I want to talk about the Opendoor stock today. This is a really popular stock. I mean, this was a SPAC around the exact same time as SoFi and all the other ones. This is very similar to SoFi, honestly, because Chamath was the one that brought it public. Same thing with SoFi. So a lot of the, crowd that invests in SoFi and invests in a lot of the SPACs also are pretty familiar with Opendoor. For those of you guys that do not know, Opendoor is a fintech company. Their main goal is to create like an app that is one-stop shop for anybody that is buying or selling homes. So you can go to the app if you're looking for a home and you want to buy one, put in your area code, put in all the parameters that you want to look for, and then search and be able to buy it right there from the home. You can do virtual walkthroughs, everything like that. If you're, on the other side and you've got a home that you want to sell, you can list it and go through the whole process that way. What they're trying to do is create a one-stop shop, have an app that's got financing, it's got renovation, it's got everything. So you only have to use one single app to do the entire buying or selling process from start to finish. So, a lot of fintech companies nowadays, guys, it's almost like every company is a fintech company. So I wanted to look at this one a little bit closer. I want to look at the fundamentals and see if it's got, some value there. I also want to look at the charts and see if it's got a technical setup that could be beneficial. Like I said, guys, about a month and a half ago, it was setting up like beautifully. Then it played out and it was on a tear. It was running really nicely, but it has since pulled back to a major support level, and there could be some good opportunity here. So we'll break that down. Let's go ahead and get started, guys. First thing we're going to look at is the earnings report from Q3. Real quick, I did go through their shareholder letter for Q3, and I wanted to just kind of mention a couple of things. Guys, they have been growing their customer base by 90% on average quarter over quarter since their inception. That's pretty big, guys. I mean, growing customer base 90%, almost 100% every quarter is not easy to do. The next thing, guys, is they did make a couple acquisitions. So they made an acquisition with Pro.com and Skylight.com, which are both like leaders in the, fintech interior renovation, industry. So home renovation, interior design, stuff like that. Again, that adds value as another, option to better your experience. They also made an acquisition with another company called reddoor.com, which is a financial, a financing company. They also released 2 new buyer products to make it easier for buyers to buy a home. So with that being said, guys, let's jump in and kind of take a look at the numbers of what they actually posted for Q3. As you can see here, guys, they posted Q3 GAAP EPS of -9 cents, so they are currently posting negative earnings. They did beat, however, though, on the EPS by 8 cents. You can see that there. They did a revenue of 2.27 billion, which was a growth of 570% year over year. That's obviously insane, guys. Growing at 500% year over year, is pretty massive. The revenue, 2.27 billion. That's a lot of revenue, guys, for one quarter. Most of the SPACs we look at don't even do 2 billion in the entire year. So something to keep in mind. The revenue was a beat by 260 million. Very impressive beat on revenue there, guys. But I want you to notice something. Adjusted net income of -17 million versus 2 million, positive 2 million in Q2 of 2021. So they did more revenue, but less net income. So what does that tell you? Their gross margins, or their net margins, actually went down. So something to keep in mind and something to look a little bit deeper at. If they did more revenue but less net income, got to figure out why. We want to see companies growing net income, not losing it. Expanded to 44 markets at the end of Q3 with 5 new market launches. So they are now in 44 different markets. They launched 5 brand new markets, within the quarter. They purchased 15,000 homes, which is up 79% from Q2. And then they grew their inventory balance to 17,164 homes, representing 6.3 billion in value, up 130% versus Q2. Guys, that's a big jump there. As you can see, they had 15,000 homes that they purchased in Q3, but they grew their total inventory balance to 17,000. So a majority of their inventory came right there in Q3. One thing that this does not say that I did read in their shareholder letter, they sold a little over 5,000 homes in Q2 or in Q3. That's what made up the revenue of 2.27 billion. So they're, if they can continue to sell 5,000, homes a quarter or a little over that, and can continue to grow that, they could be doing pretty well. One thing that I think is really interesting, look at the guidance, guys. So they issued, Q4 revenue guidance of 3.1 to 3.2 billion versus a consensus of 2.92 billion. So pretty big jump there in their guidance on revenue. They must be really confident that they're going to continue growing on the amount of homes that they're selling, because they just acquired 3 times what they sold in Q3. So just wanted to throw that out there. As far as the adjusted EBITDA guidance, they pretty much guided for -5 to +5 million in adjusted EBITDA. So again, decent revenue, really good revenue, but not very good, on the bottom end. So with that being said, guys, I want to jump in. Let's take a look at historical growth. So this is revenue from 2017. That is insane growth, guys. I mean, going from $711 million in total revenue in 2017 to 4.47 billion in trailing 12 months is very, very impressive. One thing I want to point out, 711 to 1.838 billion. So they literally more than doubled from 17 to 2018. And then from 2018 to 2019, look at that, 1.8 billion to 4.74 billion in 2018. That's a big jump, but then they got wrecked in 2020, probably due to COVID. Nobody was probably buying homes. Very understandable. They dropped down to 2.58 billion, and they are right back at it to 4.47 billion. Guys, if they do, Q4 of 3 billion, that's going to put them at upwards of 7 billion. That's a big jump. So going from 4.7 in 2019 to 7.4 billion in their in 2021, they're growing revenue like crazy. This is a very fast growing company, and I think you should absolutely be paying more for overall growth. Their price to sales ratio is right around 2 right now because the price is down so far. And I think that's pretty in line. That's not too bad there, guys. I think the price right now at around 15 bucks is actually very reasonable based off what I can see, but I do have a couple concerns. If you look down here at the gross profit looks pretty solid, guys. That's a decent gross profit margin. However, if we drop down to the net income, they're losing a lot of money. They were losing 84 million in 2017 to 241 to 341, 260 or 286 in 2020. That went down because obviously they just had less operations, but 558.9 in their trailing 12 months, guys. They're growing revenue quickly, but they're also, losing more money, year over year. So I would really like to see that net income start to go the other way. I want to see them start losing less money, not losing more money. Obviously, they're probably financing growth and putting everything back in the company, but guys, they've grown their revenue unbelievable amounts, in the last 5 years, 4 years, but their net income hasn't gone the right way. So that is a concern of mine. Next thing I want to show you guys, let's take a look at the balance sheet. So from the total, just like straight health of the balance sheet, they've got a total current assets of 8.8 billion and a total current liabilities of 4.24 billion. So that's not bad at all, guys. They've got double the amount of total current assets than they do total current liabilities. So if something happened and they had to liquidate everything, they could pay their debt off twice and be just fine. So good, pretty good, healthy balance sheet. They probably aren't going to go out of business anytime soon. This is my concern though, guys. Look at the total shares outstanding from 2017 to 2020. 39 million, 78 million, bought some back or something happened right there in 2019 to 51, and then 577. Obviously, this is when they went public, right? They went public in 2020. So, obviously you're going to see a massive jump in shares there because they went the SPAC route. They had to issue all those shares. But right here in their trailing 12 months, they went from 577 to 612. So they already did another, share issuing, and they haven't even been fully public for more than a year. So something to keep in mind, guys. I mean, if they continue to issue shares like that, that's not good. You don't want to see them just continuing issuing shares. So keep a very close eye on that if you plan on buying this stock and holding it for the long term as a fundamental play. Now let's jump over and take a look at the cash flow statement. This is my number one concern right here, guys. As you can see by the cash flow statement, and for those of you guys that do not know, the free cash flow is on the cash flow statement. You take your cash from operations and then you minus off your capital expenditures. Take a look at their cash from operations in their trailing 12 months, around 6.3 billion. Now, what did they say in their earnings report? They acquired 15,000 homes for a total value of around 6.3 billion. So all of their free cash flow went to inventory. You can see here though, every year they have had negative free cash flow. The only year that they had positive free cash flow was during COVID, and it was probably because they weren't acquiring new inventory. Actually, it looks right here, changing inventory. They actually did get quite a bit of inventory in 2020. So I don't know exactly why they had positive free cash flow in 2020. It was probably because they had way less operational expenses due to COVID, and just the business was probably a lot more stagnated. So, the free cash flow in 2020 was not bad. It was around 660 million. But guys, until we start to see the free cash flow start to go in the right direction and they can post some type of positive free cash flow, I'm going to be a little skeptical. It's going to be a concern for me, and I'm going to watch it. As far as investing in this company for the long run, if you believe all of these numbers, if you really like the growth, if you like the outlook of Opendoor's, platform, their fintech, I've never used their platform, then this could be a buy for you at these levels, especially where the price is today. I think the value for the stock is a little bit higher than it is today, strictly based off the fact that it's a fast growing company. They're in a big industry. They're growing revenue at an insane rate. And I think in the next couple of years, you may see, the free cash flow and the revenues or the net income start to flip and start moving in the right direction. I don't think they're going to go positive in the next couple of years, but at least moving in the right direction. And with how willing people are to way overpay for stocks with no free cash flow and no net income, you could see the stock, reach a much higher price. But guys, for me, it's just not something that I would have a lot of conviction in today. I will absolutely trade it on the short term. And honestly, I probably would even buy, a little bit here and there, or a very small percentage of my portfolio if I could get it at a really good price and willing to take the risk on it because of how fast it's growing. So I like the growth. I like the price that it's at today. I just don't like the free cash flow. I don't like the little bit of dilution, and I don't like the net income. So something to keep in mind. Last thing, guys, let's take a look at the chart. The chart's actually not too bad in the sense of like education. There's a lot we can take from this chart. Obviously, the chart is not bullish by any means. As you can see, it is literally the exact same price that it was a year ago or over a year ago in September of 2020. There's so many assets out there that are way, way above the price that they were a year ago. So definitely an underperformer. Keep in mind, guys, this is one of those SPACs, very popular, but the SPACs also got wrecked, most of them at least. Let's go over a couple of things that I think are really important in this chart that I want you to take note of. Back here on September 15th of 2020, it gapped up, made an initial all-time candle high close, and it hit an intraday high at like $18.08, creating your inflection zone. Pulled back to fill the gap, back test the top of the gap, before rallying up, thrusting through the inflection zone. And then look at what happened right here, guys. It broke the inflection zone, but then rallied it. So it back tested that inflection zone. Rallied up, pulled back. Okay, so it made that initial all-time candle high close on October 15th, got rejected and pulled back. Couple of things here, guys. We made a higher low than the previous discernible low. This is why it is so important to learn how to map out inflection zones and ice lines and support resistance, critical levels, things like that. It is not what happens, guys. It is what the follow-through price action. So a couple of things. When it pulled back, the intraday low on October 26th successfully back-tested the level as support, came up off it the next day, but then broke it a few days later. Not what happens. What happens after the fact. It's the follow-through. Then it had a spring, back test of spring, confirming what was once resistance is now support. Guys, this is why we take trades on spring back tests, because when you back test a spring at a major inflection zone, that is the most low risk area you can possibly get. And yes, some of them may fail, right? You may get some successful back tests that just break it again the next day and fall to much lower prices. But in this context right here, you have a rally, you get pulled back, you make a higher low than the previous low, you have a successful spring back test of a major inflection zone, and you rally. Because of that, you not only broke through the previous resistance level, but you made a new level. You made a intraday high back here on December 22nd of 2020. The high was like $32.39 before pulling back. And look what happened. Higher low than the previous low, higher high than the previous high. But we also, on the next rally, we had the next rally, got rejected, made a lower high than the previous high, sold off, but still made a higher low. So then what is that? That's indecision, guys. When you're making like those triangles, you're making, lower highs, but you're making higher lows. It's just indecision. And so once that kind of played out, you had the big up thrust, making another intraday high back on February 11th, 2021 at like almost $40. Then it dumped, guys. So look at what happened. You had clear as day, and I'll even mark it out for you. Bearish divergence on a significant time scale like the daily. That is a clear sign to get out, to head for the hills, guys, especially at a major level like that. So again, very educational. Then it dumped. Okay. Now on the downside, this is where a lot of buyers get trapped, guys, because you have a big dump, big vicious dump. And look at where it went to. It went to the bottom of the inflection zone that we had established back here in early September and October. You can see all the correlation. Wick low, then it back tests the top of the zone, wick high, candle close. So there's a lot of correlation there. Pulls back, and then buyers start to see it rally over the next couple of days. But it's called a reaction, guys. It dumps, has a reaction, makes a lower high than the previous high. So that is just an attempted rally just to make a lower high, bleed, and dump again. Then you make a lower low than the previous low, attempted rally, pathetic attempted rally at the inflection zone, and dumps again. Guys, if it would have successfully back tested this level, it probably would have went back to 26.56. You can see in between that level, straight up, straight down, straight up, holds above, straight down, straight up, straight down, and the pathetic attempted rally. But even over here, now what happens, guys? After it could not hold, it bottomed out at the top of the gap, attempted rally to confirm what was once support many times is now resistance. Not once, but twice, dumps again. So then what are we working on here? A very, very nice double bottom. This is technically called an Adam and Eve double bottom because you've got a V-shaped bottom and then you've got a big, big, wide, rounded bottom. You could also look at this as a dragon. You've got your head, front foot, hump, second foot, and then your tail. Most people take the trade after the supply line is broken. I wouldn't have taken the trade here because you're right under a major zone of inflection. But you can see once it broke the tail, it had a big gap up just to get rejected again at the top of the zone, pulled back tested the supply line as support. Look at that. That is so textbook, guys. It broke the line, back tested the line as support before rallying, back testing the top of the zone. So we broke the zone of inflection, back tested the bottom of the zone, rallying again to back test the top of the zone, and then we're off. And look, guys, we literally hit the measured move almost perfectly, you know, of the double bottom. Now, don't get me wrong, we went a little bit above it, but you're right at resistance, guys, and you had triple MACD bearish divergence, and you're butting up against major resistance. So you got to get out. You take profit. That's why you use your measured moves. And then it dumps again. And when it dumped again, it broke the 200-day moving average, you know, broke the zone of inflection, and then even back tested it as resistance before falling back to the next major level. So guys, that's why we map out support, resistance, critical levels, inflection zones, because when you're looking at an asset like this, you can see it back test the top of a major zone like that. There's a good chance that it's going to keep moving. It's going to go straight to 26.56. So that would have been a beautiful entry right there. This right here, guys, once it broke the inflection zone and then back tested the bottom of the zone, once you got strong follow through like that bullish engulfing candle the next day, you absolutely could have took the trade and then just put your stop loss under the inflection zone. That's why you map it. So as of right now, guys, it's not looking really good because you're under that zone. You're under 17 bucks. I would want to see it get above 17 dollars to $18.08. I want to see it above the zone before taking any type of trade. You're under the 200-day moving average. Couple of things here. Your negative momentum on the daily is waning. You're starting to lose it, but you got a ways to go. Your relative strength index is oversold. You actually had the lowest level of relative strength that you have ever had ever. That is not good. That is a sign of weakness. What you need to see here, guys, you did have a beautiful bullish engulfing candle that is in development and is confirmed today. Not in development, excuse me, it's confirmed. So technically, you are at some of the most low risk levels and you did just get a bullish signal. However, guys, that's kind of like rolling dice. You know, flip a coin, see which way it goes. You got to see what happens in the follow through. So it could, you know, reverse right here. It could make another rally again to make a lower high than the previous high and dump again. Or it could, you know, rally, back test the zone, and then there's your trade setup. Once you get above here, you can marginally set your stop loss right underneath the inflection zone and have a really nice low risk trade. Now, why do you not take the trade at this inflection zone? Because it's held support many of times. You could, but why wouldn't you? Because your risk to reward is just not high enough. If you take a look here, guys, and if you were to take the trade here, even right at the zone, put your stop loss there, and then put it at the top of the zone, you're only at 2.4 risk reward. But if you take your trade up here, put your stop loss under this zone, your target would be, you know, $25.64. That puts you at 4.5 risk to reward. So what I'm getting at here, guys, if you're planning on buying this stock in the short term, you want to trade it on a day-to-day, wait until you get above the zone of inflection. If you're buying it for the long term, you have utter conviction in this stock and you love everything about it, Sure, these are absolutely the most low risk levels, but guys, you could continue to see lower prices. You absolutely could break this, 1390 to 1283 level. You could have again, tempted rally, dump again, and you could see, 9, 10, 12, $4, who knows? So I just don't like it right here. I did love when it was doing this first valley, second valley, third valley, and then it's off. So just keep that in mind, guys. You've got to be really careful in the market conditions that we're in right now. The macro is looking pretty sketchy. However, the index funds did have a very strong day today, which came out of nowhere. I can't even believe that it, didn't get wrecked today. But with that being said, I could see Opendoor holding these levels and working its way back up to, the inflection zone. And hopefully, if the macro doesn't get wrecked, Opendoor will do just fine. So put it on your watch list, guys. Keep an eye on it. But that's it for today. This video is for entertainment purposes only, guys. I'm not a licensed stockbroker. Always do your own research and due diligence. Come join us at the Patreon. Go follow me on Instagram and Twitter. And I'll see you guys in the next one. Peace.